The earlier you get into investing, the better off you're going to be in the long run. So today I'm explaining some really easy ways that teenagers and other young people can get started on their investing journey with not too much effort and of course not too much financial output either. Let's take a look. How's it going, guys? Ryan here and welcome back to another investing video, and today we're talking about how young people, including teenagers, can get started in investing. And this is certainly by no means any sort of financial advice. Make sure you consult with a financial professional, but rather giving you some ideas, some tips and tricks in order to get started on your investing journey. And as most of you probably already know, the earlier you get started in the investing side of things financially, the better off you are going to be later in life. So getting in early, even just getting an understanding early, is going to help you significantly and compound in the long term. So without further ado, let's get straight into it. So to kick things off, and first thing first, one of the most important things before you get into investing is financial discipline. And two key things need to occur. A, you need to be able to save money, and B, you need to be able to reduce your costs as much as possible. When you're a young person, these are very, very important if you want to start investing. And that's typically because you don't have either much money to begin with, or if you do have a job, quite frankly, it's not going to be paying that much either. So that means any costs that you're incurring, they are going to have a big impact on your savings, and as a result, your ability to invest. So a great way to get started is simply just get something like an Excel spreadsheet and track your incoming and your outgoings. So your incoming is, of course, your income, whatever you are earning, whether that be through pocket money, whether that be through a part-time job or any other means. Then your outgoings are the costs you're incurring throughout your life. So if you have a car loan, for example, you're paying that off. Or if you're simply going out with a few mates, you're buying a choc milk, some chips, some lunch, that sort of thing. These are costs that aren't necessarily something that you need to do. Of course, kids need to go out and have fun, but reducing those costs can certainly help you get into investing. So I'd really suggest get your savings in order and get your costs down as much as possible so you can really leverage your ability to get into investing, whether that be in the stock market or any other means. One of the first investments that you should make as a young person is investing in your own knowledge. So things such as courses and books are very helpful. There are many classics such as More Money with Noel Whitaker, or one of my other favorites if you're looking to get into the stock market, Bulls, Bears and a Croupier. Fantastic books that you can easily go out and purchase, and you're not outlaying much money, but what you're going to get is a significant amount of knowledge through reading these books. And as you start to learn more, you'll start to understand more, and that's going to help you not just getting started in investing, but throughout your entire life when it comes to finances overall. As I mentioned at the start of the video, this is about getting in early to get a really good understanding of exactly how you're able to change your life financially, not necessarily just from an investing perspective, but from a savings perspective, but from a cost-cutting perspective, all these different sorts of things. So books such as More Money, for example, are fantastic ways that you're able to leverage this and get into the habit of learning how to invest, learning how to save, learning how to cut costs, and ultimately learning how to build yourself a better life moving forward. Now, really getting into the financial side of investing, one of the absolute safest things that you can do is to put your savings into either a high interest savings account or into a term deposit. Now, of course, everything comes with risk, but these are absolutely, in my opinion, one of the lowest risk ways to increase the amount of money that you have by effectively doing nothing. Simply just leveraging your bank account or whatever bank you're with, or moving to another provider and getting a high interest rate on your savings can generate you some quite good money. Let's say you had $10,000 of savings in the bank, for example, that you'd saved up over time. Moving from a bank which provides, a 1% rate where you're getting an extra $100 per year against your name in your account, versus one that's providing maybe over 5%, is going to make a difference. Although it seems small, that's an extra $400, a total of $500 that would be in your pocket that you can use to buy things such as books, such as courses, or even to continue to compound and grow your money overall. Term deposits, given inflation at the moment and interest rates being high, are actually quite lucrative. And what you do is you basically lock up your money in a term deposit account for a brief period of time and sit back and watch that money come through and compound on the returns. Then, if you don't need that money at the end of your term deposit, you can put it all back in once again, including the profit you've made, and keep compounding that money. The concept of compounding is incredibly important here, because growing your money using your existing money is easier with the more money you have. So if you start early and start compounding that money, much like superannuation for instance, you are really going to reap the rewards later in life. You've got to remember, becoming rich is not a sprint, it is certainly a marathon. Now, moving on to what I really enjoy, and that is obviously stock investing. Now, this is significantly more risky, and absolutely make sure you're consulting financial professionals, and if you are a young person, your parents, for this sort of advice. But make sure that you have a look at the stock market. Consider it, but focus on safe things, or relatively safe speaking. So things such as exchange traded funds, also known as ETFs, that track the overall stock market. It's been known that returns on the stock market roughly provide per annum on average 10% per year. Your money sitting there in one of these ETFs, you doing absolutely nothing, is generating you 10% worth of that value year on year. And if you keep repeating that process over and over again over a long period of time, you're building that compounding effect. This is incredibly important. Once again, of course, nowhere near as safe as having it just sitting in a savings account or a term deposit, but more importantly, it is a great way to get started in the stock market, start learning, start actually earning a bit of money through it in one of the more safer means possible. If you are looking to invest in individual companies specifically, I would recommend, from my personal experience, not from a financial perspective, once again, not financial advice, to look at blue chip stocks. These are stocks which are relatively stable. They can either be growth stocks which grow in value over time very slowly, or dividend-based stocks which will pay you a dividend every so often. This is helping you generate a bit more money if you have chosen the right stocks, but that's certainly where you would need to consider consulting a financial professional before you do get involved in that side of things. Stick to the safe options. Make sure you do a lot of research, get into those books, see if there's any courses, plenty of free content online, including my YouTube channel, for example, where you can just learn and continue to grow your knowledge before you do get involved in that side of things. Now, to really wrap things up, I want to share with you one of the most important rules in my opinion, and that is consistency is key when it comes to investing. Make sure what you're doing is, when you're able to allocate each month or each pay or wherever it may be, some money dedicated to enabling you to invest, whether that be purely through investing that consistently in an interest or savings account with a high interest rate, or if that's consistently putting money towards an ETF or if you're using that money to buy books, to buy courses, in order to further your knowledge, make sure you are consistently investing in yourself and of course in assets that are going to generate you wealth over time. This is the key, and this is the beauty of where compounding, of course, comes into play. One of the best ways to really grow your wealth slowly but surely over time and actually get some really good results out of it. So make sure you are consistent with your investment into your investing journey. That wraps up today's video, guys. I'd love to hear your thoughts down in the comments section below and other tips and tricks that you certainly have for young people looking to get into investing. If you did enjoy today's video, make sure you do leave a thumbs up, and if you want to see more of this sort of content, hit subscribe and turn on those bell notifications. I'll leave it there for today, guys. I hope you have an awesome day. I'll see you next time. Cheers.